All right.
So we are back with the podcasting. We went out and bought a bunch of new equipment. So the audio is good and the video is good, and
Hopefully, no more technical difficulties.
hopefully no more technical difficulties. But I think the main reason that I want to do the podcast again is because I feel like dialogue is really important. So this is not to get attention for having a podcast. The podcast thing, I feel like everybody wants to do a podcast now. But given the industry we're in, there's a lot of sharing of information. And we can share a blog, we can draft out an email to somebody, and sometimes it's a little harder to grasp the concept of something just based on having to read it.
Hmm.
Whereas if we record these conversations, we're recording dialogue, and people often learn very quickly from watching other people have a conversation about something that is maybe unfamiliar to them. And so that's the hope here. We're not looking to gain some big following, although that would be nice. But yeah, but hopefully this is something that, we can have a conversation about and then repurpose for clients so that they can listen to it and gain knowledge from it.
Yeah, because a lot of like when you and I talk on the phone or just about anything, like we're talking about something that's relevant to whatever's going on, deals that we're working on, stuff that's happening around us, and it's if you were a fly on the wall, it's something that the fly might find useful. And sometimes we don't realize we're talking about important stuff for something that others might find of value. So no, I'm glad we're doing this.
And we don't always think alike, which is a good thing.
Yeah, you're usually wrong.
Oh,
No, I'm joking.
we often have differing opinions or perspectives on things, and that helps us learn. So, there's probably going to be a lot of these conversations that we have where, yeah, we do agree on certain things like policies and procedures and underwriting, and a lot of that is very black and white. But I think when it comes to the opinions of kind of what we're seeing in the industry, and maybe that's where we differ. And
Yeah.
then I find that when we have those conversations on the phone where nobody else is listening, I'm like, oh, I wish other people could hear this because
Hmm.
they would gain perspective from listening to this.
Yeah, it's always like points of view. You need points of view to not always align. You need them to differ because it benefits both sides. Like it's still right or wrong. It still challenges me to consider something I probably didn't consider, and vice versa. And it only helps strengthen the opinion or make it go in the direction that it should go to gain knowledge. So that's good. Whether it's in life, under mortgages and whatnot.
And so, what have we been seeing that isn't necessarily new and surprising? Because I don't feel like anything is new and surprising anymore.
Yeah.
But what have we been seeing lately that if people are listening to this, will understand that there's more than just that person going through it? This is not unique to them. It's probably something that's happening to many people.
Yeah. I get a this lady that gives me like a massages for my back and stuff, and she was just talking to me about like, oh, how's the industry and whatnot, and she was asking like, hey, is there something that we didn't talk about this yet? It's the perfect time, but she's like, I see her later today actually. She's like, oh, you do mortgages and stuff. I'm like, yeah, and she's like, oh, how does it work? What do you guys do? What are you guys seeing? And long story short, she basically explaining to me how times are tough and she's blessed to be as busy as she is, but for some reason that, it feels like it's heavy. There's a lot of debts there. She wants to consolidate. And, she's like, I'm embarrassed to say it, like that I'm in this situation. I'm sure other people aren't. And I'm like, no, actually. So, like, to answer your question, like, a lot of people think that they're in a situation by themselves and like their neighbors are doing great, their family members are doing great, people across the street buying new cars, buying. The reality is everybody is going through it. The same thing. Interest rates are high, groceries are expensive, clothing is expensive. You still have, I got personally weddings to go to this year, and like nothing stops. So you got to figure out a way to do these things. And so that was a little bit of a relief knowing that she wasn't alone. Even though it didn't solve her problems in that moment, it was something that was reassuring to her, be like, okay, like other people are going through it. We just don't talk about it. So, in her case, I was explaining to her, what we can do. A lot of people look at their home as a way that are fortunate or current homeowners as a way to fix their situation. Refinancing, consolidating debts, having one payment, kind of clearing that slate is a good way to get back on track. So that's what I'm working on with her. Kind of segue into this is I'm noticing a shift in interest rates, lowest interest rate, still something that people want, but I think people are more concerned with cash flow, and increasing it and having the lowest possible payment. And believe it or not, amortization is probably more important to people than the interest rate. Even though they think interest rate is important, they would much rather have a higher interest rate with an extended amortization than a slightly lower interest rate and being capped at 25 or 30 years.
I think that's always been the answer.
Hmm.
The only difference now is people are uh, they're more okay with the idea of having a higher rate.
Yeah,
Before is they wanted both. They wanted the lowest rate, maybe the highest amortization. That's not always going to be the case. And now people are foregoing the lowest rate for higher amortization or lower payments. So
yeah,
it's a shift in mentality, not necessarily a shift in a strategy, because that's always been around, but a shift in mentality. And I think it took rates going as high as they are, or did, sorry, and then coming back down to the place they're at now for people to realize that it's actually not so bad to be in the fours. Like right now, we're in the fours
yeah,
for most rates, and some of the B lenders are, you know, just a little above five, which is nice to see after the last 2 years. Those aren't horrible rates. They might be to you because you had a 1.5% rate during the COVID years, but in reality, it's actually not a bad rate. So when you've experienced a 6.5 or 7% rate, which is what they had gone to, and now we're back down to the fours and very low fives, you're like, okay, could be far worse.
yeah,
But there are some people that had never experienced that in their entire life, and then they did, and they thought the world was ending, and now we're back to normal, healthy levels. Well, not quite, but
hmm,
close.
yeah. Things are kind of simmered off a little bit, or they're stable, so much more manageable. And I think it was a reality check for people, realizing that the low interest rates that we had for like a decade almost wasn't the where we're going to be all this time. And so when we kind of spiked up to where we did, a lot of people felt the crunch. And now that we've kind of fallen to the fours and the fives, depending on the category of lending, it's not so bad. It's not so horrible. So
Yeah.
it's definitely been a good reality check for everyone.
I think rates are so much more important for maybe first time buyers, but a little less, not maybe important is the wrong word to use. I'll give you an example. So if I tell somebody who I've never met before what I do, their immediate question to that is, "Oh, how's the industry going? How are the rates looking?" It's not that I hate the question. I don't. Maybe I just find it a little bit irritating because it's just like people put so much emphasis on rates, and that kind of perpetuates the problem in the industry where everyone's looking for the best rate. I get it. Rate is important, but it's actually, in my opinion, not the most important anymore. I think for first time buyers, it is extremely important, but for first time buyers, they'll also get the best rates if they're putting less than 20% down. So it makes it easier to be like, yeah, this is the best rate you'll qualify for. But for people that are renewing or refinancing, there is no such thing as the best rate.
Yeah,
Because the best rate, if you're asking the question, what is the best rate available for a mortgage today? The answer is you're not going to qualify for the best rate because you don't get the best rates for renewals. You don't get the best rates for refinances. And I think people have a hard time understanding that when they hear that from a mortgage broker. If I'm as transparent as I'm being now and I tell them that, they probably think I'm nuts. And I
yeah.
usually preface by saying, listen, I know you're going to think I'm crazy. Hear me out, but here's my little spiel about rates.
Yeah, it's the industry or banks, lenders across the board. Whenever they advertise rates, as we know, it's always based on the insured rates. Because why would you post or advertise, you know, a less lucrative rate than what you can offer? So it's always that, and then only until you start applying for it or inquiring for your own situation do you realize that, oh, it's not applicable to you. Most cases, it's not. So you'd have to be like high ratio insured purchase, you know and it's only available for that. It's funny that you mentioned the whole, like, when somebody finds out you're a mortgage broker, and they say, "Oh, how's the industry going? How's the rate?" I experienced that, kid you not, yesterday.
Yeah.
Oh, how are things going? Oh, what do you do? I'm a mortgage broker. Oh, how are the rates? It's like we don't have to do small talk.
Yeah, yeah. So I think it maybe is about small talk because they don't know what else to ask.
Yeah.
And I've always been like that too. Like I'm not as interested in what people do for a living.
Hmm.
And this is such a segue into just a personal opinion, but like I'm not interested in what people do as a living because I don't
Yeah.
like when people let what they do define who they are.
Hmm.
If you're meeting somebody for the first time, one of the first questions you should never ask is, "What do you do?"
Yeah.
Why does it matter what I do? You're meeting me for the first time. It doesn't matter.
Yeah.
But there's so much importance behind what you do as a career. Even like when you watch those game shows and stuff, it's always like, you know, this person's name, how old are they,
Yeah.
what they do for a living. Those are like the only things
Yeah.
that people seem to care about. But there's so much more to talk about.
Yeah.
But you're right. It's like I don't need you to do the small talk.
Yeah.
Rates are good. Rates
Yeah.
are rates are fine.
Rates are
Let's
good.
move on.
Yeah. Are you, it's also like, are you up for renewal or something? Are you looking to buy? No, I'm locked in for 5 years. I'm happy I'm not changing. Well, then I guess it doesn't matter.
I think I'm not even bothered by the question as much because of there being so much importance on like what somebody does, but more so because it's not an easy question to answer. So tying
Yeah.
back into what we were just talking about is there are additional questions that you have to ask when somebody asks what's the best rate before you can get that answer for them.
Yeah. I think that's probably what it is for me too. It's just an oversimplification of what's the best rate. You can answer that question, but there's so much more behind it to really help the other person understand, but you don't really want to get into that
Yeah.
to the extent that is necessary.
I've had people get upset with me on the phone, like a brand new call, never spoken to the person before. The one of the things they want to know is like, what's the best rate you guys have? And then I'll start to probe additional questions to find out more about their scenario so I can answer the question accurately. And they'll find that upsetting. So they'll be like, well, I don't need to go down that road. I don't need to answer all these questions. Just tell me the best you have. And I'm like, that's such a bad attitude to have about it because I'm literally trying to help you get the best rate you qualify for, or at least tell you based on your scenario.
So, kind of tied to what you're saying. So, with renewals, we get clients calling for renewals and their mortgages are maturing and they kind of want to know what we can offer. And one of the questions I start with or near the beginning ask is, well, do you currently have a renewal offer? Have you been given anything? And most of the time, people are generally transparent and open and they share it. Other times they don't, and sometimes they get upset. Like, well, I don't want to tell you. Just tell me what you can do. And I'm like, no, I think you misunderstand. The reason I'm asking you is because you tell me what you have currently on the table because that's going to be the benchmark to which we can compare to see whether it can be beat or not. We don't memorize rates. Like, so also like in these conversations and interactions we have with people and say, what's the best rate? I'll be honest with you, I don't memorize them because we get updates on the daily, every 2 days. One lender will outshine another and vice versa. So instead, it's like when a situation presents itself, let's pull it up. Let's see who's like the best of the day based on your situation, and we can speak to that. So for that reason, when a client says like, "Oh, I've been given X such and such rate for this renewal," I'll say, "Okay, let me compare it now." Sometimes it's to, they might have a great exceptional rate from the existing lender, and we'll just tell them, you know what, that's probably where you should stay. And in fact, sometimes I encourage them to say, "Look, this is the best rate we can get. Go back to your bank and say you spoke with a broker. This is what they can get with this lender. See if they'll match it or beat it because sometimes it's not worth their time, cost, energy, jumping through hoops and hurdles to switch from one bank to the other. Whereas the existing bank will just amend their rate, send you the paperwork, sign it, send it back, and it's done. So yeah, sometimes clients are don't understand, so they get defensive about their holding back information or not wanting to answer questions that you're only asking. Like you're not asking them, "Hey, what did you do yesterday? What TV, what shows did you watch?"
I think they get upset because of uh, maybe bad experiences in the past.
Oh,
Just
100%. Yeah.
if people only knew how honest and transparent we were about renewals, especially, well, everything, but those renewal calls specifically, only because we're on the topic, is we seldomly close renewals where we switch from one bank to another for somebody.
Yeah.
Because more often than not, we're just honest right from the get-go, and we tell people this may not be worth your time and effort. Even if it's to save 5 or 10 basis points, like, are you willing to go down the road of the underwriting and seeing a lawyer and discharging and re-registering to save 5 basis points?
Yeah.
Just go back to your bank and just get them to match what we're telling you. We'll save you the time and effort. That we don't make any money off of that. In fact, we're actually turning down business that other people would try extremely hard to sell somebody on, which in my opinion I don't agree with, because you can pull the wool over somebody's eyes and make it seem like this is the most amazing thing for them over the next 5 years, but if it ends up being a break even because they're only saving $2,000 but they have to spend 2,000 in legal fees, it's a
What's the point?
wash. What's the point? What's the point of it all?
Yeah. People don't realize that, but that's where we come in and we kind of explain it to them. And I think so far we've had good experiences and appreciation that's been expressed by these people, like clients or non-clients in that situation. But one day there will be a need. One day they'll maybe need to take out money. One day it might make sense for them to do something or shake things up with their existing mortgages. And then who are they going to call?
And that's usually when it does make sense, is
Yeah,
when they're looking to change any of the particulars of their existing mortgage. So increase the loan amount, increase the amortization again, take out equity. Well, increase the loan amount, so
yeah.
take out equity to consolidate debts or renovate or whatever the case is.
Have you had any difficult? I mean, it's a funny question because I know you have. We both do difficult deals and transactions that like situations that clients bring to you that you kind of they're not like straight line, start to finish. It's not like pay stub, job letters, qualifying's easy, and here's a mortgage, away you go. Has there been, just so like people that are listening can see, like, situations that they're in versus what we see on a regular basis and say, wow, like ours is not that bad. So if I have any reluctance to go down this path because I think I'm not going to get approved, it's not the case.
Yeah,
Yeah.
for
Especially
sure.
the condos.
The condos especially are hit pretty hard. The new build stuff's hard because here's the challenge with new builds, actually. And this is the thing that like kind of makes me shake my head at some people that I've been in conversation with, because this happens with existing clients too, where for some reason they refuse to reach out to us ahead of time before they make these large purchase decisions with builders to get pre-qualified to make sure that they could even get that mortgage when the time comes. Yes, they might have a year and a half, possibly up to 2 years to figure things out. It's not a lot of time. 2 years will fly by, especially if you're not practicing good habits with things like credit. If you think you're going to sell your home and then eventually the time comes and you're like, you know what, I want to keep my home. Like, as an example, I have a couple people now that I've been in discussion with. One of them you actually don't know about, just somebody that bought a new built home. And I kind of remember telling them not to do it. Like, telling them, like, listen, we should really pre-qualify ahead of time. Like, let's do like a real hard underwriting of this and figure out your numbers. And then telling them, even when they inquired about a particular builder, telling them that's outside of your affordability. That's going to be hard.
Yeah.
They ended up doing it anyway. And I didn't know this and I found out after, but they had actually filed a consumer proposal
During that time.
during the same time.
Okay.
And I didn't find out about that until after. Throw in the mix of one of the applicants being business for self, and I wish I had been able to stop them from purchasing this property. But now they're in a binding contract.
Mhm.
What I'm finding out from another client is, the fear of being sued by the builder is always there. Whether it actually happens or not is a different story,
Yeah.
but it actually happens. It's happening. And they'll keep your deposit and they'll list the property to sell it, and they'll list it at a far lower price than what you paid for it
Mhm.
because they have your deposit to offset that. And then if there's a difference in, if they end up selling for less even and there's any loss on their end at all, they'll sue for punitive damages,
Yeah. Like whatever the difference
whatever
is,
the
plus
difference
costs.
is.
Yeah.
And so now I'm starting to see that. Before it was just a thought where we weren't really seeing it happen often, because people were just able to make things happen before because property values were going up. Now property values are coming down. A lot of banks do need appraisals. unless it's like a high ratio insured deal. But even then, there's a possibility you still might need an appraisal.
Yeah,
You can't just go out and buy a house for whatever you want. The property drops and you think to yourself, I got nothing to worry about. I'm buying this high ratio. Well, the insurers know too that the
yeah.
property values drop.
And they're the ones that take on the risk, right? They're the ones that are insuring the bank's money against losses. So like they're definitely interested in making sure that, like any insurance company, collecting premiums and minimizing claims. So yeah, definitely appraisals are not obligated to come in at what you want it to. Just because you're willing to pay $3 million for something, just as an example, that doesn't mean that the appraisal is going to agree with it or the market's going to agree with that. So that's essentially what an appraisal is.
Yeah. And the insurers are taking on the most risk. In
Yeah.
a lot of situations, if you are buying a property within reasonable market value, you probably won't need an appraisal. With a
Hmm.
lot of the new build stuff, though, a lot of these insurers and banks will still want to see appraisals. They're not
Yeah.
just comfortable with going with the purchase price.
Yeah.
But anyways, I wish people would just get pre-qualified ahead of time. I actually think it's too easy to buy a home from a builder.
It is. So our first home, when we bought it, it was, I'll tell you what I was thinking or what we were thinking at the time was that we're not quite ready to close on a home that you could just pick up today. And so we needed time. And so, builders offer like these new build homes and stuff that's going to be built in a year or two. And when we were doing our calculations and stuff and where we would be in life and in our jobs and whatnot, we figured, you know what, that we could use that time. We'll be ready. And luckily it worked out for us. However, I think that's kind of like the mentality that a lot of people still have today, or is that, you can go out and lock in a price that you're going to get this home, you're going to lock in a price, and at the end of the day, you don't have a mortgage, and you won't have a mortgage for that 2-year period. But what people aren't really, or maybe they are now, but didn't really realize is that they also assume that the property values were going to consistently go up. So even if you're agreeing to buy something today for 600,000, in 2 years that home should be worth 650 or seven. So you're making money without making any payments. Like it's a no-brainer. However, that didn't quite work out for those that bought in the early 2022s. And I know family members and friends that got into a situation where they locked in, thought everything was going to be great and well, and now they're part of that pool of people, a lot of people that their homes aren't valued that much, or their mortgages exceed the value of the home. So even if they sold, they would have to still owe the bank money.
Right.
So yeah, it's not necessarily a smart way to go.
Because the opposite, if you own a home and are buying another pre-construction with the intention of selling your home, you're locking in the purchase price, which is great if property values go up,
Hmm.
but is bad if property values come down. But if
Twofold
you,
is on the sales
yeah,
side too.
exactly. Because if you lock in the purchase price and property values come down, whatever you've calculated to be your equity in the home that you own that you're going to sell to use to buy that property, that's also going down.
Yeah.
So you have to be extremely calculated in that situation to
Hmm.
make sure that there's enough of a buffer there. And I always tell people to be extremely conservative. For some reason, people want to just be exact. Being exact in an industry where property values can change from one year to another and your time horizon is 2 years or 2.5 years, you have to use conservative numbers.
Also, exact isn't good either because like nobody, and people do this all the time. You shouldn't just go out and put, let's say you get 200,000 from a sale of an existing home, and I ask you what's your down payment, and you're like it's 200,000. No, it's not. Is that all the money you have? Like, not, it's a lot of money, but when I say all the money you have, is that like what you have to work with? And like, yeah. So then your down payment, to my response is, your down payment isn't 200,000. Your down payment has like that 200,000 has to go towards land transfer taxes because you're not a first time home buyer. Has to go towards legal costs. Has to go towards miscellaneous thing, appraisals, and whatever else might be there. Plus, are you going to be? Is there a new bed that you need, a new stove, other things that you might have to purchase. So deduct all of that, then you have whatever's left as your down payment. But even then, it's like you're going to put every single dollar and cent into that home and not have anything in your bank account is not necessarily a good thing, even if you have a steady job, because at the end of the day, you can't predict COVID.
Mhm.
You can't predict a job loss, unfortunate health incident in
Oops.
family, maybe you got to take care of your kids get sick, time off of work, tariffs, yes, tariffs, that you're in an industry that all of a sudden gets impacted, you get laid off temporary or otherwise. So having money for a down payment is great. You need to set aside money for the closing costs, which includes the things I mentioned, but also for things that you can't even predict. It's you need that rainy day fund, which I think this current state that we're in society doesn't really kind of factor in, or maybe things are just too expensive that they can't afford to have a rainy day fund. It just gets depleted. How do you deal with that? Going back to that deal that you were talking about with the new build at the time, you wanted to pre-qualify, but they didn't, and they got in a consumer proposal. You didn't learn about it. Like, what's the outcome with that? What's happening?
I think it's a lot worse than they realize it is. The reality hasn't kicked in yet, and I don't know if they're just being very hopeful, which I wouldn't blame them if they are, because they're committed to it. It's a binding contract. So they're kind of just hoping it'll work itself out. But the reality is that it's just a very extremely difficult situation, and they are trying to sell their home now too. So that's been listed for about 50 days, and they might not be able to sell for what they wanted to sell for, which is where their down payment is coming from.
Mhm.
And it's a very expensive purchase, so they do have to put 20% down. It also has to be like a B type deal because of the proposal.
Yeah. Does a proposal, do you think, would it need to be paid off? Because with purchases, sometimes they can let it be. I know with refinances, they tend to absolutely want the proposal to be paid off as part of the
It's a
structuring.
pretty new proposal. I think in either scenario, I'm even concerned about the qualifying income. So even that is a challenge of its own. So proposal aside, which is yes a layer of complication, there's still the challenge of income.
Yeah.
So I what I did, and this is not a solution, but what I did to make sure, because they have their home listed. So my moral compass is like, well, I can't possibly allow you to continue listing your home and making you feel like there's definitely going to be a solution here for the
Yeah.
purchase. So I ordered an appraisal for the purchase, knowing that one's going to be needed. 100% they're going to need
Yeah, for sure.
an appraisal on that purchase. And they're confident that the value's gone up. I'm thinking I'm thinking the value's gone down, which is a problem because then there's going to be a shortfall. And so because that's an unknown, we can't really maneuver until we know what that value is.
Yeah, you won't know how much is needed for the purchase. We also still is a question mark on the sales side because at the end of the day, like let's say the appraisal comes in less and you're right. That means that they need more equity from the sale, but they can't just control what the home sells for. Like at the end
Exactly.
of the day, the buyer controls that, and the only thing they control is whether they accept it or not. But they can't wish for it to be more. It
Right.
just
And so I don't
doesn't.
want them to be homeless because God forbid they sell their home next week. That's firm. That's a binding contract. And now they have a binding contract with the builder, but can't close that property because there isn't enough money there.
Yeah,
What do? They have
yeah,
two binding contracts that they'd have to default on. Then you're going to get sued from both parties. So it's a sticky situation. I haven't yet figured it out, but the problem is some people think that there's always going to be a solution there. And most of the times there is, but there are some instances where things just don't work out.
Well, in this case, like what people that are listening might not be picking up on, or maybe they will, but there's always like three main things in considering like an application. It's like the credit, the income, the equity slash value slash down payment. And that scenario that you're describing has an issue on the potential issue on the equity side or the appraisal, but it also has an issue on the credit side with the consumer proposal. And you obviously looked at the income, and the qualifying income's not enough. So when you have three things of those categories that aren't necessarily good or great, then it's a very steep mountain to climb. However, if you have two out of the three that are solid, sometimes you're able to overcome the third thing because the other two are so strong. And it depends on the combination of which twos. But yeah, the more of those things you check off, the better your chances of getting approved and successfully closing. When you have a situation like what you just described, it's really hard. And then in this market, appraisals, even if you have great income and great credit, an appraisal can just ruin the whole transaction. Yeah, and it has. Fortunately, there's no you can't pull a solution out of the hat if the value is not there and you don't have a way of bridging that gap. So unfortunately, it is what it is for now. And over time, property values do go up, but we're just in that period where it slumps a little bit. Any other any other things that you're kind of working on?
There's a lot of private stuff.
Just talk about that
Yeah,
for a little
private's
bit.
growing in popularity again. I feel like it never really died off, to be honest with you. Even through COVID, private's always been pretty popular. People need to tap into their equity. And so private's good for a couple of reasons. One, they don't really qualify you based on the traditional metrics of like credit and income. A lot of private lenders care, like they'll price you based on credit, but they don't care that you have bad credit. It's not
Yeah,
enough to decline a deal, especially if equity's there. Income, they don't care about so much at all. There are some lenders that'll ask for income docs, but it's really just to make sure you don't owe a lot in personal taxes. Like, a lot of the times it's just to make sure taxes are paid.
yeah.
I don't care what you pay. You could claim $10,000 a year. That's irrelevant.
And just to jump in very quickly, I find that private lenders aren't concerned with credit because credit just shows you like an overall profile of like how likely are you to pay and pay on time and stuff. But private lenders also know that if you're gonna not pay something, it's not them. Like they know you might not make a bill payment to, your cell phone bill or, a credit card maybe, but they know that when it comes to your home and them being a private lender and them not being afraid to exercise their right to remedy the situation if you don't pay them, that's why they're not so concerned, I think, in my opinion, of credit or things like that, because yeah, they know they're getting paid. You're gonna pay them first, is essentially my point. But anyways, continue.
Now, a lot of times that's true, but there are times when bad credit can be indicative of just
Yeah.
poor repayment history in general across the board, mortgages included. But what I'm seeing a lot of, so we're getting a lot of clean private deals, maximum 80%. In some cases, we can stretch it to up to 85%. That died off a long time ago during COVID, but then kind of is slowly coming back because property values have somewhat stabilized. In my opinion, stabilized. I don't think we're seeing massive decreases or continuous decreases in any type of home. I think they've been hit hard already, and now we're just recovering from that. So some lenders are going back above 80%, but nothing more than 85.
Hmm.
But I am seeing some people ask for up to 90%. So there's situations where people call us, they have a first mortgage to 80%, which is the max you can get for a refinance. They need an additional private mortgage to upwards to 90%. And that is unlikely. I don't have a single lender that'll do that. I don't know. Well, maybe I know of a lender that has done it, but it's got to be on like a detached home in a very marketable area, great value, but it's also still very rare.
It's also like carry a responsibility, and a lot of clients don't think or don't know this, is that we carry responsibility and an obligation to the client to make sure that they can afford the payments, whatever they may be. We have to assess, because from a client's perspective, in a desperate situation, they're willing to just take anything, right? So we have to be like I guess the clear-minded, clear head to say, okay, well, like show us your stuff, show us your income, show us your credit, show us your goals, what's your exit strategy, and we need to be able to assess like, is this actually something that you can sustain? Can you sustain it for the term? What's your plan after the term? Oh, like we got to figure that out. But also, we have to figure out whether in the worst case scenario, should you not be able to carry this because something happened, like a life event happens, we got to protect the lender as well. We can't just because the lender is willing to go up to 90%, even though I don't know of any currently. We can't just be like, okay, here's a lender and here's a borrower. There you go. We get paid and off we go. But we have to make sure that we're not putting the lender in harm's way either, because at the end of the day, there is an obligation to them and their interests as well as the borrowers. So it's not, we just won't do everything. It has to make sense. It has to be the right thing. And we've turned away deals that could technically be done, but we tell the clients, like, look, listen, this is a time to sell. And I remember one client who was like very stubborn. And I don't mean that in a disrespectful way. It's just, it's your home. It's just something you protect and it's like, your fortress, if you will. and he was reluctant to sell his home, ultimately did, and it's realized afterwards it was the right thing to do, and he was able to walk away with some equity, money in the bank. He's renting now, but just to kind of reset his foundation, and he'll get right back in the market when things are cleaned up. So had he not taken that under advisement, he would have been forced to sell his home and walked away with nothing. And so, yeah, that's kind of like the reality of clients to kind of consider. And they think that that's not the case, that they would ever be like, not a situation that they would ever be a part of, like being forced to sell. And they always think they can patch this and patch that, but it's not as easy as you might think it. So private is definitely a lot more popular. It's always been around, you're right, but it's a lot more prominent now because, like you said, the restrictions, sorry, there's not less red tape in order to qualify, but not an ideal choice. And you definitely need a exit strategy.
Yeah, exit strategy is definitely key. And if you're working with a broker who cares about all the parties involved, then they will discuss exit strategy with you. Because first and foremost, it's important to you as the borrower, because you shouldn't ever be stuck with a private mortgage for longer than maybe 2 years, right? Unless your time horizon is 2 to 3 years, and but you do have an exit strategy already, that it should never be carried for that much longer. And if you're not discussing exit strategy, then there's a whole element of that process that's missing.
Yeah, they're not meant to be like traditional mortgages that you keep for 25, 30 years. They're mortgages that solve a current problem, like a temporary problem, with like having the foresight to know that, okay, in a year when the term is up, or maybe one extra year on top of that, this is what I'm going to do to get rid of it, whether it's to refinance, consolidate, because that's the amount of time I need to do that, or I'm selling my home. I know I'm going to do it. I'm just not ready to do it right now. I don't want to go through the hoops and hurdles with the the A side or the traditional lending, so I'm just going to go through this way. But as long as you have that plan of getting out, private is an excellent choice. But a lot of people kind of just maybe ignore that part and just like, I need to solve this today. I'll worry about it tomorrow. Well, tomorrow comes like that in a year or two, and they're not ready. And so what ends up happening is like they go and get another one to pay out this one, and that's when it spirals out of control.
And don't let somebody in our industry, any broker or agent, feed off of your desperation. We'll figure it out later is not an answer. Don't worry, we'll deal with it next year. Not an answer.
Yeah.
And if you're not asking the question about what your exit strategy is, and that's not coming up naturally in the conversation, now you know after listening to this that that is a question you should be asking.
Yeah, and that's actually maybe a red flag. If you're not talking, if the broker that you're dealing with is not talking about your exit strategy, is not concerned or showing interest in that, then maybe they're only here to help you with this, and they might not be able to help you with that.
Well, we've seen it happen all the time, right? Yes, this is not a pro bono position. We It may seem like it because we get paid when the deal closes. So we do the work leading up to the deal closing with the hope that it will close. But if it doesn't, we don't charge upfront fees. You're not paying for our time. That's a problem in a way, because people in our industry might do whatever and tell you whatever you want to hear to get to that finish line. And once they get paid, they get paid. They don't have to help you next year.
Yeah,
They don't have to help you with an exit strategy. They could very well come back to you next year and say, sorry, it's just not going to work this year for the reasons of X, Y, and Z.
wish they should have maybe known last year.
Maybe should have known last year, or maybe circumstances change. So I'm not saying in every single one of those situations that's what happens, but there's going to be instances where you could have known from day one whether this was going to be possible next year. We talk to clients all the time about the possibility of needing to sell. Selling is an exit strategy. It may not be an ideal exit strategy, but it is one. But we tell people, well, numbers are very tight. If rates don't improve, or if credit doesn't improve by this time next year, which is when we should start applying for the refinance, the possibility might be that you have to sell your home or be stuck with this mortgage for another year. And in a lot of cases, people can't be stuck with the mortgage for another year because year one was prepaid. If year one was prepaid and they weren't making payments on it, well, you can't do that for year two at a renewal. So you kind of have to do everything over again if there's room. But it is a red flag if anyone in our industry is not talking to you about exit strategy, it's a red flag. If they say to you, "Don't worry, we'll figure it out next year," it's a red flag. It's a bunch of BS, and just save yourself the stress.
I remember you had a deal or a client you were telling me about that should have sold like this time around this year, but they're like, I'm just not ready. House prices are not good. So I need a second. Let's just call it a second. This might be a made up story in terms of this particular details, but the point is that you did the math and you're like, okay, house prices aren't there. Next year, the house price might go up like 20, 30, 50K, fine. But if you do go down this path of mortgaging on the private side for the amount that they needed, they'd be paying that across the interest and the closing costs anyways. So like, and that price appreciation might not even happen by next year. So you're paying $50,000 for 1 year, let's just say, but by next year, your home may or may not even appreciate by 50,000. So it ends up being a wash or worse. Like
But we get
your
this
math,
all we get this all the time, and people aren't. They're not mathing. They're not trying. They're not even trying to do the math.
yeah,
So it's hard to be too hard on them. They're just hopeful. They're hopeful that property values will increase to levels that we've seen in the past. And while that will be true over the long term, it's not going to be true in the short term. So if you have to do a slow bleed financially of carrying very expensive mortgages that are going to cost you, and I'm talking first mortgages too. It doesn't even have to be a private mortgage. It could just be a very large first mortgage that maybe is unaffordable, that is a mortgage you shouldn't have gotten in the first place.
mhm,
That's going to cost you $5,000 a month collectively for the next 12 months, but you're hoping that your home's going to appreciate by 50 to 60,000, which is a better time to sell. It's a wash.
yeah,
It's a complete wash. It doesn't even matter. So you might as well just sell now. And sometimes selling, we're not trying to encourage people to sell. This isn't like bad news. We're just saying if you're in a really tight financial position, selling, knowing that you are going to tap into 20% of your equity that you wouldn't otherwise be able to, and then doing something smart with that money could actually propel you forward more than keeping the home and hoping for the value to increase.
yeah. Sometimes even the peace of mind, like with the client I was telling you about before that ended up selling, walking away with something. From a peace of mind standpoint, not having that like above your like on your shoulders, that burden, knowing that you have money in the bank account, even though it's like for the future purchase, just knowing that's there, and all you're doing is paying a significantly decreased single individual, by the way. So just needs a one-bedroom apartment, basement apartment. Like I know they're expensive today, but significant, like a third of what he was paying before. That has to be a fresh of breath here, breath of fresh air. And I know, like from a stress, a peace of mind, quality of life standpoint, he's doing just fine. And I think more people need to consider that and not feel like they're behind in any ways if they have to take that step. Because like we were talking at the beginning, there's a lot more people in this situation contemplating the exact same thing, but they don't realize it because when they go outside to water their lawn, there's a new car across the street. The neighbors are having a great time or a party or barbecue and stuff, and you're just thinking, okay, it's just me. It's not. So leave it at that.
Okay.